Welcome back and thank you so much for joining me again today. My name is Adam and we're going to start off today's video with a very simple question which might not be so simple. What do these companies have in common? Nike, Bank of America, Sherwin-Williams, Lowe's, Apple? All completely different industries, right? But each of these companies pays a dividend.
Nerd alert!
And simply put, a dividend is when a company takes a portion of its profits and pays it back to its shareholders. Kind of like a thank you for investing in us. Something you can always count on paying dividends is by subscribing to this channel and smashing the like button. It helps with the YouTube algorithm. In today's video, we're going to discuss the details behind dividends, the benefits of a dividend investing strategy, and then lastly, what to look for when you're going to invest in a company that does offer a dividend. So let's get going. Now, just as a disclaimer, I am not a financial professional. I'm not a fiduciary. This is not financial advice. I'm literally just sharing some of the information that I found on the internet and putting it into video format to make it easy. So you don't have to ruin your eyesight because mine's definitely getting bad.
Hey, old man River, zip it or I'll break your hip.
Why dividend stock investing? What makes owning a company that pays a dividend so compelling? Well, your return on investment can come from two different avenues. The first is going to be the appreciation of that stock itself. You purchase a stock at $10, and when you sell it, it's $20. Well, you've made $10 per share. You've doubled your money, and that's great. With a dividend-paying stock, you're also going to receive a yield or distribution, and every company is a little bit different here. Some distribute every month, some every quarter, and then some annually. And this is determined by its board of directors, and the amount that's actually dispersed is also determined by its board of directors. The most common distribution or dividend is paid out quarterly. What are some of the benefits of dividend investing? Well, a lot of the companies that do pay a dividend are larger and more established. So in the case of hardship or an economic downturn, the likelihood of your investment going completely away is pretty minimal to very low. I don't want to say it's zero because I'd be lying, but the likelihood of it just going completely kaputs, not very likely. The second thing is the concept of compounding. This allows you to build more and more ownership in a stock on a company. This happens using DRIP. All right, DRIP just simply means dividend reinvestment plan, but you're going to take the money that a company gives you every month, quarterly, or annually, and put it back into that company so you buy more shares. All right, the more ownership that you buy, the more the stock appreciates, the more dividends you get. It creates this beautiful circle. Lastly, companies that offer a dividend very rarely get rid of the dividend or decrease the dividend, which is good, especially if you're looking to utilize a dividend for income. While dividend investing seems all honky-dory and it's a huge victory, there are some drawbacks as well. The first of which is that these companies are not necessarily high growth companies. So the appreciation of their actual stock price is not going to be as great as a stock that maybe does not pay a dividend, right? If a company has the ability to take in profits and then pay shareholders back, that means they can't reinvest that capital back into business and growing the business. The second of which is it takes a lot of capital to make a consistent income just off of dividends. And to prove this point, we're going to look at one company in particular, something that's been around for over 100 years, and that's Coca-Cola, which pays a dividend. So how much money would you need to invest in Coca-Cola right now in order to even get $1,000 every quarter, or which would equate to about $4,000 a year? So we're going to head over to Yahoo Finance. We're going to pull up Coca-Cola, and at this time you'll see it's trading at just under $50 per share. And in the middle of your screen, you'll see the forward dividend and yield. And that first number there at $1.64 represents the dollar payout annually per share that you own. So to calculate the dividend per quarter, you take that $1.64, you divide it by 4 for 4 quarters, and that'll give you 41 cents. Now we want to make an average of $1,000 per quarter, so we're going to take that $1,000 divided by the 41 cents, and this will give us the amount of shares that we need to own, which is just over 2,400 shares in order to make $1,000 per quarter. What would our total investment need to be in order to own 2,440 shares? You take that amount, multiply it by the current stock price of just under $50, and the total investment cost would be just under $122,000. This isn't petty cash by any means, but this investment would give you a return of $4,000 per year.
There are 4 key dates to keep in mind when investing in dividends. The first of which is the declaration date. This is when the board of directors gets together and announces they will be paying a dividend. The second is the date of record, or the ex-dividend date. Now this is important because you want to be a shareholder on that date in order to be entitled to the dividend payout. The third of which is going to be the date of payment, so that's when you actually receive the dividend into your brokerage account. And the fourth one is your significant other's birthday. That's important, don't forget that one. Well, what about other diversified forms of investing like ETFs? Do they also pay out dividends? And the answer is yes. If that ETF holds stock that pays out a dividend, well, so will that ETF. Now, every company pays out their dividend on different days, so the ETF won't distribute randomly. It will hold all those funds, usually until the end of the quarter, and then pay out all your dividends within that ETF simultaneously. What about a completely different asset class? Like, let's say you owned real estate in your portfolio in the form of a REIT, a real estate investment trust. They don't necessarily call it a dividend, it's called a yield, and you'll still receive a distribution every month, every quarter, or annually. Before we identify what to look for when dividend investing, just word to the wise and something to not do. Don't just look at a company's dividend payout and invest in that company because it's the highest. There could be a reason why that dividend is so high, and one of those reasons could be a declining stock price. And that's something you want no part of. All right, now it's meat and potatoes time. What to look for when investing in a company that pays out a dividend. First and foremost, you need to understand what that percentage of yield is. So very simply, look at the dividend payout for the entire year, divide it by the stock price, and that will give you a percentage. Now, I look for anything that's 2% or more, but some people say that 2% is too conservative, and they look at for 3% or greater. So it really just depends on what you're looking for and what kind of return you're trying to get out of your dividend stock. Secondly, look for a company with a long history of paying out a dividend. The longer that company's been around, the less likelihood they'll go away, and also the less likely they're going to be cutting their dividend for any reason.
We're going to slide back onto Yahoo Finance, and along the top toolbar, you're going to see historical data. On the next screen in the middle section, you're going to see the historical price. We want to switch that drop down into dividend only. Then we're going to change the frequency on the right side from daily to monthly. Then we're going to switch the date range. Now remember, we're looking for a stock that has a 25-year or more history of paying out dividends. So I'm going to slide this all the way back here to the mid-90s. And then once I hit apply on the right-hand side, it'll bring up the dividends for that select period of time. So you can kind of scroll, all the way down here and look at the history of the dividend and make sure that the dividend here has been consistent. It's also important to note that as you look year over year, you want to see this dividend consistently growing as well.
Now, while you're reviewing the dividend history, look at the growth rate of that dividend payout. If it's growing year over year and it's growing by multiples, that's a dividend you want a piece of. With any investment, we want a certain margin of safety, and with dividend investing, that's no different. Here, we're looking at the dividend coverage ratio. This is the amount of times a company can pay out a dividend based on its earnings. For an example, a company earned $10 million. They pay out $1 million in dividends. That means 10% of their earnings are going to the shareholders. There's plenty of working capital left. Now, shoe on the other foot, let's say $9 million gets paid out to shareholders on $10 million worth of earnings. That means they only have 10% of their capital available for operations, and that can prove very difficult for a company financially and can put them in poor financial standing going forward. Earnings growth is also very important. And if the company is not at least increasing its earnings by 5 to 15% per year, it's not worth your time. Move on. We want to steer away from companies that carry a large debt sheet. And to do so, we're going to look at the debt to equity ratio. Simply put, we take the total amount of liabilities, divide it by the equity, and that will give us a number relative to that ratio that we were looking for. Anything below 2, we're on the relatively safe side. The lower the number, the better it is for dividend investing. My overall opinion on dividend investing is that it's part of my portfolio, but it's not the bulk of it. What I'm really more concerned about is owning quality businesses that I see are going to be around for the future and have a good amount of growth opportunity as well. Because I don't want that investment just to be stagnant, collecting a low dividend payout without that growth exposure. Feel free to drop a comment and let me know what you want to see more of here on this channel. As always, save, invest, and grow. Ciao, ciao.